Hello, I'm Eddie Adkins. Welcome to my video on the Earned Income Tax Credit for 2020, a credit you claim on your tax return that's due in 2021. First, I'll tell you just a little bit about myself. I'm a certified public accountant, and I spent over 25 years as a tax partner in two different accounting firms. I'm retired now, which I'm very happy about, and one of the things I'm doing in retirement is making tax videos to help people, hopefully people like you, understand tax issues. So thank you so much for joining me on this video. I do want to tell you right up front, this is a very thorough discussion of the Earned Income Credit. So the video is going to be over an hour and a half long. It goes into a lot of detail. Just to help, I have a hot cup of coffee here, and I have a big glass of water. I promise it's just water, otherwise things might get just too interesting. And you may want to get a beverage as well. Put me on pause and go fetch a beverage and settle in for a big detailed discussion of the Earned Income Credit. It is a thorough discussion. It's not just an overview that might leave you asking a lot of questions and having a lot of unanswered questions. Now, I realize that not everyone is in for a long video that goes into a lot of detail. So I have made two additional videos. One I call a quick summary of the Earned Income Credit. I put a link to that in the description for this video. So if you want to go there, you can go there very quickly. That video is about 5 to 10 minutes long, not very long, and I think does a pretty good job of at least giving you a summary of the Earned Income Credit. Then I do have a somewhat longer video that I call an overview of the Earned Income Credit, and that's about 30 minutes long, so it goes more deeply into the subject than the quick summary, but certainly is much shorter than this video. You might even want to think about looking at the quick summary first. Then if you think you're eligible for the Earned Income Credit and want to know more, then go to the overview video. And then if you're still interested, come to this longer video. One thing I have done also, because I realize this video is quite long, it's just long because the rules are complex, I have put links in the description section of this video that will enable you, if you want, to jump right ahead to certain topics covered by this video. So if you want, take a look at the description section and you'll find those links. I hope you'll just go through the whole video with me, and I think you'll learn a lot. I think it will be worth your time. But again, I realize sometimes people are really short on time, and so they need to get answers and they have particular topics in mind. So I'm trying to make that easy for you to do if that's what you want to do. As I've mentioned, this video is lengthy. I've sort of apologized for that in advance. I do think it's worth watching though, because the Earned Income Credit can save you up to $6,660 in taxes for 2020. So it well may be worth your while to really dig into this topic, the Earned Income Credit, with me. Income tax rules are complex. That's why it takes a lot of time to really thoroughly explain the rules. My goal though, and I've worked hard on preparing this video, my goal is to make it easy for you to understand the rules for the Earned Income Credit by taking you through them step by step by step. So I really do think if you listen carefully, follow along with me, I think at the end of this video you'll feel like you know a lot about the Earned Income Credit and have confidence about whether you qualify for it, and if you do, how much it's going to be worth to you. What's the amount of your Earned Income Credit? I will cover these again, the requirements step by step. One thing to keep in mind is as I go through the requirements, if I come to one that you don't meet, you can just turn me off and stop watching the video. You don't need to continue. So what I'm anticipating is that only folks who learn as I go along that they qualify for the credit, they meet all the requirements, only those folks will actually go all the way through this video with me. So if you make it all the way to the end, that's going to mean really that you qualify and that you're going to get the credit, which can be worth a lot of money to you. Now, there are some rules that apply only in certain limited situations. So basically what I'm saying here is the earned income credit, like a lot of areas of tax rules, are just very complicated. And they address a lot of special situations. They have a lot of special rules for certain situations. If I went through all of those things, we would be here together for hours. And I don't want to put you through them. So what I'm going to do is I'm just, for those situations which I think are fairly limited in terms of how many of you might be subject to those rules, I'm just going to mention them so you know about them. I'm not going to explain those rules, but I am going to tell you where you can find more information about those rules so that if they apply to you, I'm not sort of leaving you hanging. You'll know where to go to get more information. So I hope that will be helpful to you. If I tell you that there's a rule, and I'm not going to cover it in detail because it is applicable only in certain limited situations, I'm going to tell you where to go to find additional information. And generally, I'm going to refer you to an IRS publication or to an IRS tax form and perhaps the instructions that go with the tax form. And I'm going to put links to some of those items directly in the description section for this video to make it really, really easy for you to go to those additional resources. YouTube does limit me on how much I can put in the description. I guess they just don't want people putting pages and pages and pages of description because that really doesn't do anyone any good, so they limit me. So I can't put links to everything I'm going to mention, but I will put the major things I'll put links for in the description section. If I have not put a link for a publication that you want to go look at based on what I tell you in this video, there's a general IRS website. It's listed here for you, irs.gov, forms, instructions. I will put that in the description section so that you can click on that. And then all you have to do when you go to that website is put in the publication or form number or the name of the publication or form. It's going to take you right to that particular resource. And you don't even really have to go to the IRS website. You can just go to your search engine and put in something like IRS publication 596, for example. It should take you right to that publication. So it should be fairly easy for you to find the additional resources I refer you to if there is a special rule that applies to you that I don't go through in detail. My objectives for this video are really threefold. So this is what you're going to get out, or at least I hope you're going to get out of this video. The first is I hope to enable you to determine whether you qualify for the Earned Income Credit. And I really think after listening to this video, you're going to know whether you qualify for the Earned Income Credit because I am going to cover those requirements in depth with you. Next, assuming you make it through that part of the video, in other words, you'll go through that with me and you will conclude based on everything I say that you qualify for the credit. Some of you won't, and you'll hopefully just turn me off. You're welcome to keep listening, but I don't know why you would if you don't meet all the requirements. But assuming you do, then next we're going to talk about how you determine the amount of the Earned Income Credit. And I'm actually going to show you tables where you'll get at least an approximation of the amount of your Earned Income Credit. Because I know that's what's really important to people, is how much is this worth to them. And then finally, we're going to wind up the video with giving you an understanding of how you claim the Earned Income Credit. So that's really going to be about when you do your tax return, on your tax return, how do you go about claiming the Earned Income Credit? So those are our objectives. Here are the topics we're going to cover in this video, and they're very much related to the objectives I've gone through with you. We're going to start with how credits work. I think this is so important for you to really understand how credits work so you know how the Earned Income Tax Credit benefits you. If you don't understand that, there's almost no reason to keep listening to the rest of the video. So we want to get a good, solid understanding of that. Then we'll move into the requirements to claim the Earned Income Credit. I'm going to go through those requirements with you in depth. And as I said, if I come to a requirement that you don't meet, you can simply stop listening. You're welcome to keep listening, but there would really not be much point in continuing to listen if you don't meet the requirements. We'll then jump into the amount of your earned income credit. I will explain to you how the amount is determined and give you the tools to actually approximate the amount of your credit. And then, of course, how to claim the earned income credit, because you do need to claim it if you qualify for it. So that's our agenda for this video. Before we jump into the agenda, I wanted to share some interesting facts with you. Given that I'm doing a thorough video on the earned income credit, I felt like that we needed some context here. The first thing I want to share with you is that 17% of all taxpayers took the earned income credit in the year 2018. That's the latest year for which I have data available. 17%. So just a little short of 1 out of 5 taxpayers actually took the earned income credit. So a lot of people do take the credit. It actually translates into about 27 million income tax returns on which the earned income credit is taken. So millions and millions of returns. The next fact I want to share with you, which I find really, really interesting, is that 22% of taxpayers who were eligible for the credit in 2016 didn't claim it. So that's about 1 out of 5. 2016, by the way, is the latest year for which I have data available. So about 1 out of 5 taxpayers who could be claiming the earned income credit actually aren't claiming it, and so they're leaving money on the table essentially because they're not claiming it. And this leads to a very, very important point, and you're going to hear me repeat this a couple of times in the video. You don't get the earned income credit automatically. It's not like the IRS is going to figure out whether you qualify for it and give it to you if you qualify for it. You actually have to file an income tax return and claim it. So you might be eligible, but you don't file a return, or you file a return and you don't claim it on the return, you're not going to get it. So you do have to be proactive to get the earned income tax credit. Now, let's jump in and talk about how credits work. A very important topic because, as I said earlier, otherwise you're going to sort of lose your way and not really understand how it benefits you. The best way to tell you how credits work is to give you some examples. And I have 3 examples. And incidentally, if you have listened to my overview video already, you will have already seen these 3 examples. But rest assured, as I go throughout the rest of this video, you're going to see a lot of information that you don't see in my overview video. So before I go through the 3 examples, I just want to set the stage for you generally. So when you have a credit, first, you just figure out the amount of taxes like you usually would. And so, as you probably know, that means adding up your income, subtracting out your deductions, coming up with a taxable income amount, and then going into the IRS table to look up what is your income tax liability for the year. Well, when you get a credit, you still do all of that. So that's completely unaffected. You still do it. But then what happens with a credit is it reduces your taxes dollar for dollar. And that dollar for dollar reduction makes credits like the earned income credit very, very valuable. So let me show you that and really show you how valuable it is by going through 3 examples. My first example, let's say that the taxes on your income, so you figure up your taxable income, you go look at the IRS table, and it says that your income taxes for the year are $2,500. But now you have learned that you're eligible for the earned income credit and that the amount is $1,000, and we'll talk later about how you determine the amount. Let's say it's $1,000. You get to reduce your taxes dollar for dollar by $1,000. So we take the $2,500, we subtract $1,000 from it, and now your taxes are $1,500. So you've just saved $1,000 as a result of the earned income tax credit. So it's really quite wonderful. Let's go to another example, a little bit more complicated, not that much more complicated. We're going to say, again, like in the first example, that your income taxes, when you figure them up, are $2,500. But let's say that you had taxes withheld by your employer, and of course if you're employed, your employer is withholding income taxes, and let's say that they withheld for the year $3,000 in taxes. Well, when you file your return, it's going to show that your taxes are $2,500, but that you've had $3,000 in income tax withholdings. So the IRS is going to owe you $500 and they'll send you a refund for $500. I know a lot of people look forward to those refunds every year. But now let's say that you've determined you're eligible for the earned income credit and that the amount is $1,000. So now the IRS owes you not only the $500, but on top of that, $1,000. So they're going to send you a refund now of $1,500. So again, a very, very nice benefit you're getting from the earned income credit. The final example, and I love this example because it makes such a good point. Let's say that the taxes on your income, when you calculate them, are zero. And that would be because your income's just not high enough to result in any tax liability. And in fact, your income tax may be low, or your income may be low enough that you're not even required to file a tax return. But now let's say, again, you figure out that you're eligible for the earned income credit and you determine the amount and it's $1,000. Guess what? This is wonderful news. The IRS now owes you $1,000, even though you actually had no tax liability. Perhaps you weren't even required to file a return, but they owe you $1,000. They're going to send you a check for $1,000. But, and I make this point again, I made it already, I want to make it again, you must file an income tax return to get it. That is such an important point. Now here's some good news for you. In my examples, I've been using a $1,000 earned income credit, but for 2020, the credit can actually be as high as $6,660. I think I mentioned that number already. But again, it can be a very, very valuable benefit. That is quite a large dollar amount. Now, not everyone gets $6,660. It actually depends on several factors. It depends on the number of what we call qualifying children living with you. It depends on your income level, and it depends on your income tax filing status. Are you married, single, etc.? We'll be getting into all of that much later, but I did want to tell you right up front what helps determine the actual amount of your earned income credit. I do want to note, I think this is important, that you can get the credit even if you don't have any qualifying children. I think sometimes people get confused about that. We will be talking about that as we go along. So we've covered how credits work, and now we are going to jump into the requirements to claim the earned income credit. So hopefully you're doing well, you're hanging with me. Take a break if you need to. We now begin a really important discussion. What are the requirements you have to meet in order to claim the earned income credit? So here are the requirements. I'm going to read through them with you so you get just a feel at the very beginning of what the requirements are, and then we're going to take them one by one and really drill down into each one and get into the details. Some of them are very complicated, others are really quite simple, so it just depends, and you'll see as we go along. The first requirement is you have to have earned income. The second requirement is that your income must be less than a certain amount of money. The credit's not meant for high income individuals, it's meant for low to moderate income individuals. Next, you cannot file your return as married filing separately. Next, your investment income cannot exceed $3,650. Next, if you don't have any qualifying children, and you'll learn in just a little bit what that means to have qualifying children. If you don't have any, then you have to live in the United States for more than half the year. You have to be at least 25, but under age 65, and you can't be someone else's dependent. You have to be a U.S. citizen or resident alien all year. You must have a Social Security number, and if you're married filing jointly, your spouse also must have a Social Security number. And finally, you cannot file Form 2555, which has to do with foreign earned income. So those are the requirements. And of course, now what I need to do is explain each one of those to you. So let's start with the very first one. You must have earned income. And this one is sort of obvious because this credit is called the Earned Income Credit. And that's actually the reason it's called the Earned Income Credit, because you have to have earned income in order to qualify for the credit. So what is earned income? The definition is pretty simple. We talk about a lot of complicated rules later on in this video. This one's pretty straightforward, pretty easy to remember. Earned income is simply money that you have to work for to get. So it's things like wages, salary, tips, and self-employment income if you work for yourself. It's not money for work that you did in the past. So it's not things like retirement benefits you may be getting from an employer, or Social Security benefits, or money you take out of a retirement account such as a 401k plan. It's also not unemployment compensation or workers' compensation. So that's really what earned income is, and some examples of what it is not. One really important point: if you're married filing jointly, only one of you is required to have earned income. It's certainly fine if you both have earned income, but you'll qualify for the earned income credit, or at least you'll meet this requirement, if only one of you has earned income. Now remember, at the very beginning of the video, I told you that there are special rules that I'm just going to make you aware of, but not take the time to go into detail, because otherwise we'd be here together for, I don't know, 5, 6, 7, 8 hours, maybe more. So here's an example of those kind of special rules that I just want to make you aware of, but not go into detail. There are some special rules about whether certain things are earned income or not, and then if they are, how much is the earned income, which becomes important when you're actually calculating the amount of your earned income credit. And those include disability benefits. There are special rules for members of the military. There are special rules for ministers. There are special rules for earnings while an inmate in a penal institution, and also workfare payments from state and local agencies. If you want more information on those, if you look at that list and you say, I think maybe some of this applies to me, go to IRS publication 596. That's the IRS's publication on the earned income credit, and you'll find details about those special rules there. I will put a link in the description section directly to publication 596. It's a key publication for the earned income credit. It is really the major publication the IRS puts out on the earned income credit, and it's really good with giving you all these special rules. And I'll be mentioning it several more times throughout this video. When it comes to calculating the earned income, I did want to make you aware that the instructions for Form 1040, which is the U.S. income tax return that we're all pretty familiar with, it actually has a step-by-step process for calculating your earned income for purposes of the earned income credit. Now, for most people, they don't really need to go through that, because their earned income is going to be simply their wages, salary, tips that's shown on your Form W-2. But if you have a more complicated situation, maybe you're self-employed plus you have some W-2 income, that step-by-step approach is there in the instructions in case you want to use them. So I just wanted to make you aware of that. And now I think it's time for a little sip of coffee. Pardon me. I'm still fully awake, but I want to make sure I remain fully awake. And I'm sure you would like that as well. Okay, we can check off the list. The first requirement, you must have earned income, and be proud of ourselves for getting through that. And hopefully you have earned income, so you're still in the game in terms of the earned income credit. So now we're going to go to the second requirement, which is that your income must be less than a certain amount. As I mentioned earlier, the earned income credit is not meant for higher income individuals. It's meant for what the IRS refers to as low to moderate income individuals. This particular requirement is going to take us longer than any of the other requirements, because it is quite complex. It may actually take us longer than all the other requirements combined. So I guess fasten your seatbelt, hang in with me. This is going to take us a while to get through, but it's obviously a very, very important requirement, and something you need to know whether you qualify for the earned income credit. The gist of this, of course, I'll just say it again, if you make too much money, you can't claim the credit. That's really what this is all about. Now, the amount of money that you can make and still claim the credit varies depending on your situation. You know, it would be so simple if there was $1 amount and everyone who makes below that dollar amount can claim the credit and everyone who makes above that dollar amount can't claim the credit. But the rules are not written in that simple way. And so just to give you a feel for that, to qualify for the credit, some people's income has to be lower than $15,820. But some other people can get the credit as long as their income is lower than $56,844. That's a big difference. There's a big difference between $15,820 and $56,844. So the amount that applies to you depends on several factors. So that's what I'm going to take you through starting right now. So get ready. So here's a table. And you can see we say, how much money can you make and still claim the credit? And the answer to that question is in this table. But notice there are 8 numbers in this table. So you have to know which number is your number that applies to you. And it's based on 3 factors. So picking your number out of that table is based on 3 factors. 1, how many qualifying children do you have? 2, notice it says both your earned income and your adjusted gross income must be less than this amount. So you're going to have to know your earned income and your adjusted gross income in order to know whether you make too much money to qualify for the earned income credit. And then third, you have to know your filing status, your income tax filing status, because the number varies depending on whether you're single head of household qualifying widow or widower, or whether you're married filing jointly, in which case you use your combined income. So to help you pick the number from this table, and what the number says to you, whatever your number is in the table, is that you've got to make less than this amount of money in order to claim the earned income credit. What I'm going to do now is take you through the 3 factors that determine which amount in the table applies to you in order, starting with number 1, qualifying children, number 2, earned income and adjusted gross income, and then third, what is your filing status? And then we'll come back to this table and you'll be able to figure out which number you should pick out of the table to determine whether you make too much money to claim the earned income credit. So here we go. The amount of money you can make and still claim the credit depends, in part, it's one of the 3 factors, depends in part on how many qualifying children you have. And the more children you have, the more money you can make and still claim the credit. I also want to point out, as we go through this, that as you're going to see later, if you do qualify for the credit, I'm keeping my fingers crossed for you that you do, your number of qualifying children is also a major factor in determining the amount of your credit. And the more qualifying children you have, the higher your credit. So it's important not only in determining how much money you can make and still claim the credit, but if you do qualify for the credit, it's also very important in determining the amount of your credit. So this concept of how many qualifying children you have is really important. So let's talk about that. Who are your qualifying children? So this shows the requirements to have a qualifying child. First of all, the person has to be related to you in a certain way. Next, they must be under a certain age and younger than you. Next, they must live with you for more than half the year. And finally, they must have a Social Security number. What we're going to do now is go through each of those requirements and I'm going to explain them to you. As I do that, please think about whether the requirements are being met and whether you have any qualifying children. This is not a requirement to claim the earned income credit, but you have to know how many qualifying children you have in order to determine whether you make too much money to claim the credit, and then also later on to determine the amount of your credit. So it's a very important part of the earned income credit. The first requirement is they have to be related to you. And they have to be related to you in one of really 2 categories that you see here at the top of this slide. The first one is your child, stepchild, adopted child, or foster child, or any of their descendants. So could be your grandchild or your great-grandchild. Or they can be your sister, brother, half-sister, half-brother, stepsister, or stepbrother, or any of their descendants, such as your niece, your nephew, your grandniece, your grandnephew. So those are the relationships that make for a qualifying child. Any other types of relatives cannot be your qualifying child for the earned income credit. So think about how many people you have in your life that would meet these particular relationship requirements. I do want to note, because it can be important to some people, that stepchild, stepsister, and stepbrother relationships do continue even if the marriage that created them has ended. Those do go on for a long, long time, really forever. That's the relationship requirement. Next, they have to be under a certain age and also younger than you. Let's jump into what it means that they have to be under a certain age. There's a general rule that says they have to be under the age of 19. And more specifically, they have to be under the age of 19 as of December 31. So for example, for the 2020 earned income credit, they have to be under the age of 19 as of December 31, 2020. There is an exception that says if they're a full-time student, they just have to be under the age of 24. So in other words, if they're a full-time student, they can be a little older and still be your qualifying child. They can still meet the age requirement. So the obvious question is, what's a full-time student? Let's answer that question. A full-time student is an individual who goes to school on a full-time basis for some part of 5 or more calendar months during the year. And those 5 months do not have to be consecutive months. Next, if they're a student, they need to be going to a school. And a school is defined as elementary school, middle, junior high school, college, university, technical school, trade school, mechanical school. And then finally, whether they are full-time is based on how their school defines full-time. So the IRS doesn't have some definition of a full-time student for this purpose. They just say you have to look at how their school defines full-time. So let's do an example to show you how this works. Let's say that Sam becomes a full-time student at a college on January 15th, but he drops out on March 5th. He later in the year enrolls at another college on a full-time basis and takes courses during June and July. He's not a student at any other time during the year. Well, obviously Sam is having some trouble deciding whether he wants to go to school or not, so we have a sort of difficult situation here in terms of figuring out whether he's a full-time student. So here's the way we do it. Turns out he actually does meet the requirements to be a full-time student because he was a full-time student for some part of 5 calendar months. And remember, the rule is you have to be a full-time student for 5 or more months. How do we get to that conclusion? Well, he was a full-time student during some part of January, February, and March. You do not have to go to school the entire month, just some part of the month. So we get to count January as a month, even though he didn't start until January 15th. We get to count February, and we get to count March, even though he dropped out on March 5th. He was a student during some part of March. So that's 3 months. And then again in June and July, he was a full-time student. That's 2 months. So that gets us up to 5 months, and 5 months is all we need for Sam to be a full-time student. So Sam doesn't need to be under 19. He can be under 24, and he will meet the age requirement. The next age requirement, in addition to the being under 19 or 24, is that the relative has to be younger than you. And you may react to that and say, that's really silly, because how can I have a child who isn't younger than I am? Very good point, very true. So it's usually a very easy requirement to satisfy, but not in all situations. So take a brother or sister. Well, you can have an older brother or sister, in which case they're not going to meet the requirement to be your qualifying child because, yes, they're related to you in the right way, but they're not younger than you. If it's a younger brother or sister, then you're fine as long as they meet the age 19 or under 19 or under 24 requirement. There is a special rule that may help you. If you are married filing a joint return, the relative just has to be younger than you or your spouse. They do not have to be younger than both of you. And to sort of bring that rule to life, let's look at an example. Let's say the facts are that you're 21 years old and your sister's a full-time student and is 23 years old. Well, your sister meets the requirement that she's under 24 as a full-time student, so far so good. But let's take situation one. Let's say you're not married and your sister's not younger than you, she's older than you. So she doesn't meet the age requirement and she cannot be your qualifying child. Now let's move to situation two, and let's say that now you're married and you're filing a joint return and your spouse is 25 years old. Remember, you're 21, your spouse is 25. Well, your sister is younger than your spouse. So therefore, your sister does meet the age requirement because she's younger than your spouse. So that's how that rule works. One more point on the age requirement. I do want to point out a circumstance where that age requirement does not apply at all. That's why I put an X through it. And that situation is if the relative was permanently and totally disabled at any time during the year, then the age requirements don't apply. I'm not going to go through the definition of what it is to be permanently and totally disabled, but you will find the definition in publication 596, which is the IRS publication on the earned income credit. And in publication 524, the IRS actually gives you examples of what it means to be permanently and totally disabled. But again, no age requirements at all. They could be 80 years old if they're permanently and totally disabled. And also they don't have to be younger than you if they're permanently and totally disabled. So that's an important rule that can be very helpful in some situations. We're now ready to talk about the requirement that they must live with you for more than half the year. The relative must live with you for more than half the year in the United States. So it must be in the United States, and that means the 50 states and the District of Columbia. Puerto Rico and U.S. possessions don't count as being in the United States. So if you live there, you don't meet the requirement. There is a special exception to the rule for military personnel who are stationed outside the U.S. on extended active duty. Their living in another country, in that case, counts as living in the United States. I want to make now a really, really important point, and that is it doesn't matter who paid for the living expenses. This rule is not about who provides the support, it's purely about where the individual lives. Let's do an example of that to kind of bring that to life. I think this is a really important point to make. Let's say that your daughter lives with you more than half the year in an apartment that you rent, but your ex-spouse actually is paying the rent and is also paying most of your daughter's living expenses. You are the one who gets to count your daughter as a qualifying child for the earned income credit. It doesn't matter that your ex-spouse is paying the expenses. The only thing that matters is where your daughter is living, and she's living with you. So you get to count your daughter as a qualifying child for the earned income credit. Your ex-spouse does not get to count your daughter as a qualifying child. A very, very important rule. There are some special rules for the more than half the year requirement. So this is where we start to get into some more details, but they can be very important details for certain people. So we certainly cannot skip over these. And this is sort of one of the reasons why this video is a lengthy video, but you know, when it comes to tax rules, you really have to know the rules in order to apply them correctly to you, and you have to know if there's special rules. So that's why we're going through all of this. So what if you have a child away at college? Well, there's some really good news here. There's a special rule. Sometimes special rules are bad, you don't like them. Sometimes they're good. Well, these are really good rules. So you can count a child as living with you during the time when they're temporarily away from your home and not living with you. And a child away at college meets this requirement. So you have a child away at college and they're not living with you when they're away at college, and you say, you know, they're away enough that they're not actually living with me more than half the year, but you get to count that time that they're away at college as actually living with you, even though they really aren't living with you. That's one example of this sort of temporary absence rule. Other example includes time away due to illness, serving in the military, or being on vacation. So a very nice, helpful rule really helps you meet the more than half the year requirement. Here's another special rule that is really a great rule. What if you have a newborn baby during the year? There's a special rule that says if a child was born or died during the year, they're treated as having lived with you more than half the year if they live with you more than half the time they were alive during the year. So you don't look at the time, you don't look at your year, you basically look at their year. So an example would be if you have a baby in December, the baby is treated as having lived with you for more than half the year because the baby lived with you, in this case, the entire time they were alive during the year. So that's how that rule works. I want to just pause here and mention that even if you don't have any qualifying children, there's a similar residency rule that applies to you. I will talk about that a little more later, but even if you don't have qualifying children, you have to live in the United States for more than half the year. And if you're married filing jointly, both you and your spouse have to live in the United States for more than half the year. This is stated as an explicit rule for individuals who have no qualifying children. When you think about it, if you have qualifying children, you do have to live in the U.S. for more than half the year because the rule says the child has to live with you in the U.S. for more than half the year, and you can't meet that requirement unless you do live in the U.S. for more than half the year. So they impose that rule also on people who have no qualifying children so that everyone's subject to that rule. So I just wanted to explain that as a quick aside. The final requirement to be a qualifying child is they must have a Social Security number. That seems pretty straightforward, and it is pretty straightforward. I'm going to talk about that requirement in more detail later because I don't know if you can remember, but when I went through the whole list of requirements earlier, one of the requirements is that for you to claim the Earned Income Credit, you must have a Social Security number. If you're married filing jointly, your spouse must have a Social Security number. There are some special rules around that, and I'm going to wait and cover those when I talk about that requirement. And those rules, when I talk about them, will also apply to your qualifying children. So we'll get to that a little bit later. So what I'm hoping now is that you feel confident. Just stop and think about individuals who meet all these requirements and how many of them do you have. So how many that are related to you in the right ways, they're under the required ages, they're younger than you, they have lived with you for more than half the year in the United States, and they have a Social Security number. Don't worry too much if they don't currently have a Social Security number. As I'll get into later, you still have some additional time probably to get a Social Security number for them. Now, there are 3 special rules before we leave qualifying children. As you can see, the qualifying children rules are kind of long and complicated. And so here are 3 special rules that I need to explain to you. I have a slide for each one of them. Here's the first one. An individual can be treated as the qualifying child of only one taxpayer. And you may be thinking, okay, well, when would that even come into play? So here's an example. Let's say that you, your mother, and your daughter live together all year, and your daughter's 3 years old. When you think about it, your daughter meets the requirements to be the qualifying child of both you and your mother. Let's just think about that. She's your child. She's your mother's grandchild, so the relative test is met. She's only 3, so she's clearly under 19. You all live together, so you've lived together more than half the year. So you step, and let's assume she has a Social Security number. So you step back and you say, well, she's the qualifying child of both of you. You can both take the Earned Income Credit on the basis of having her as a qualifying child. No, you can't. The rule is that only one taxpayer can treat a qualifying child as a child. So you and your mother both can't count your daughter. There are rules that determine which one of you gets to count her. They're called the Tiebreaker rules, and you'll find those rules in publication 596. This is one of those rules where I've decided not to go into the details in this video because while this situation certainly does come up, it doesn't probably apply to at least the vast majority of taxpayers. So I didn't want to take time going through it. I'm going to go ahead and tell you, though, that in this case, the tiebreaker rule would say that you, the mother, get to count the child as a qualifying child, not the grandmother. However, there are rules that say that under certain circumstances, you and your mother could actually agree as to which one can count the daughter as a qualifying child. You both can't, but you could actually agree as to which one is going to count the daughter. The next special rule I have for you is that an individual might not be allowed to take the earned income credit if he or she is the qualifying child of another taxpayer. And if you're married filing jointly, this rule applies if either spouse is the qualifying child of another taxpayer. Now, to help you understand this, let's talk about a situation where this rule could come into play. I'm going to kind of use the same example I used on the prior slide. Let's say you, your mother, and your daughter live together all year. Your daughter is 3, but now I'm going to add a fact. I'm going to say that you're 23 and a full-time student. Well, that means you're going to meet the requirements to be a qualifying child of your mother. You're her daughter. That meets the relative test. You're under 24 and a full-time student. And you're living together. So you've met the requirements. But the question is whether you're going to be allowed to take the earned income credit because now you're the qualifying child of another taxpayer. And the general rule is that you can't. That because you are your mother's qualifying child, you're not going to be allowed to take the earned income credit. But it does depend on your mother's tax situation. So under certain circumstances, you might be allowed to take the earned income credit. And you'll find those details, again, in IRS Publication 596 on the earned income credit. Now, the final special rule related to qualifying children is that an individual might not be allowed to count a relative as a qualifying child if the relative is married. Here's an example of where that would come into play. Let's say that your son and his spouse live with you all year, and your son is 23 and a full-time student. So your son appears to be a qualifying child. Your son meets the relative test. He's under 24 and a full-time student. He's only 23, and you live together. So far, so good. But the rule is that you might not be able to count your son, even though he's met those requirements, as a qualifying child if he's married. In my example, he is married. So whether you can count your son as a qualifying child depends on several factors. So again, I'm not going to go into those details here because I don't want to make this video go on for hours and hours. But I've made you aware of the rule, and if it applies to you, go take a look at IRS Publication 596, and you'll get the details there. If you do have any questions about qualifying children, or if you are confused, well, one thing, if you're confused, you might just want to rewind and go back and listen to everything I've said. I know it can be difficult for all of this to sink in. It's so much information, so it's hard for it to sink in. So sometimes going back a second time, even a third time, will really help you understand it. But also I want to make you aware that the IRS has this wonderful, wonderful online tool that's called the Earned Income Tax Credit Assistant. I've given you the web address here. I'll also hopefully have room to put this in the description for this video. That will actually take you through a step-by-step process and help you determine whether you have any qualifying children. So it's a really great tool to be aware of. At this point, I think we need a water break. So excuse me while I take a nice sip of water. Feel free to join me. Water is a wonderful thing. Okay, I hope you're hanging with me and we're making good progress here. Let's keep going. Remember what we were talking about? I know it's hard to remember because we had to talk so long about qualifying children because those rules are so detailed. Remember we were talking about how much money you can make and still claim the credit? Yes, we're still on that requirement. And one of the factors is to look up the right number in the table that applies to you. You have to know how many qualifying children you have. So we have kind of crossed the first hurdle here in you're being able to pick out the number in the table that applies to you, because now I hope you know how many qualifying children you have. Do you have 1, Do you have 0? Do you have 1, 2, 3, or more? When it comes to the earned income credit, I think I mentioned this earlier, but I've kind of forgotten. Once you have 3 qualifying children, it doesn't really matter how many more you have. So you're starting now to at least know which row of this table you're on. So we're making progress. So that's the first factor. The second factor is, as it says, both your earned income and your adjusted gross income must be less than the amount in the table. So now we're going to need to talk about that particular factor. So here we go. To see whether you make less than a certain amount of money, you have to look at 2 amounts of income. These are the kind of rules that make income tax stuff so complicated. Look at 2 amounts of income. Look at your earned income and your adjusted gross income. You have to look at both numbers, and both amounts must be less than that certain amount of money that's in the table. Now, for many people, earned income and adjusted gross income are the same, but not for everyone. So I now need to talk to you about adjusted gross income. But first of all, as we dive in here and go more deeply, again, we're looking at 2 income amounts, earned income and adjusted gross income. You have to look at both. We've already covered earned income. Just as a reminder, because I know that was a while ago, earned income is money you have to work for to get. So it's things like wages, salary tips, and if you're self-employed, your self-employment income. What's adjusted gross income? We have not talked about that yet. So adjusted gross income, you start with your earned income, and then you have to add some items and you have to subtract some items. And by the way, your adjusted gross income, which I'm going to go through with you in more detail just in a moment, but I just wanted to point out that your adjusted gross income is actually a figure that appears on your income tax return. So if you have any doubt about that, it is actually shown on your income tax return. You might even want to go back to last year's return and look at that number. It's on line 11 of your income tax return. So that's a quick way to find it. Just look at line 11 where you'll see that number. But what is adjusted gross income? So as I said just a couple minutes ago, you start with your earned income and then you add certain items and you subtract certain items. So here's the list. You add the taxable portion of items like interest, dividends, capital gains. You add retirement distributions. You add the taxable portion of Social Security benefits, unemployment compensation, and a few other items that are listed here. Then you subtract the deductible portion of certain things like capital losses, self-employment taxes, contributions to self-employment retirement plans, and you can read the list for yourself to see what other items there are. So that's how you get from earned income to adjusted gross income. So I'm hoping that gives you a feel for what your adjusted gross income might be. So what I really need you to do at this point is think about what's your 2020 earned income, at least approximately, and what's your 2020 adjusted gross income. Maybe those two numbers are the same, maybe they're different, but not very different, but you need to be thinking about what those amounts are, because you're going to need to know that when we take a look at that table again that determines whether you make too much money to claim the earned income credit. Again, you have to make less than a certain amount of money to claim the credit. So that's what we're driving towards, is for you to be able to look at that and know the answer to that. So now we've covered item number 2, and we're closing in on your being able to pick out the number in the table that applies to you. But we have to do one more thing, and that is look at filing status, because you see 2 columns there, and the number you pick is based on filing status. On the one hand, are you single, head of household, qualifying widow or widower, or are you married, filing a joint return, again, in which case you would use your combined income. So let's talk about filing status. There are 5 different filing statuses. Anyone who files an income tax return checks a box to indicate their filing status, and there are 5. The 5 are single, head of household, qualifying widow, widower, married filing jointly, or married filing separately. When it comes to the world of the earned income credit, these filing statuses are put into 3 categories. We lump together single, head of household, qualifying widow and widower, and then married filing jointly. And then the third category is married filing separately. You cannot take the earned income credit if you are married filing separately. That's actually one of the rules to qualify. So remember our list of all the requirements? Here's the list. I'm going to go ahead and check off you cannot file your return as married filing separately because I've just told you that rule, and it's really as simple as that. Let's get back to filing status. I just want to give you a feel for the filing status rules so that you know which filing status you are, because again, you have to know that to pick out the right number in that table that we've been looking at. So the general rule is that your filing status is based on whether you're married as of the last day of the year. So for the 2020 earned income credit, you're looking at whether you were married as of December 31, 2020. So here's an example. Let's say Joe is single. He's single during all of 2020 until December 31st when he gets married. So it's New Year's Eve and he gets married. Let's hope that he had planned for that and it wasn't a spur of the moment decision on New Year's Eve. Okay, so he's been unmarried all year until the very last day of the year, and then he gets married. Well, because Joe was married as of December 31, he's actually treated as married for all of 2020, and so he'll file his return as married. And he can either file as married filing jointly or married filing separately, but if Joe wants the earned income credit, he's going to have to file married filing jointly. Now, there are some exceptions to the rule that your filing status is based on your marital status as of the last day of the year. I'm not going to go through all the exceptions. I did want to highlight 2 or 3 of them. The first one is if your spouse died during the year, then you're still treated as married for the year, even though technically you're not married as of the last day of the year, but you do get to file as married. Next, if you're legally separated at the end of the year, then you're treated as unmarried for the year and you would not file as married. Next, if your spouse, so you're married, but if your spouse didn't live with you for the last 6 months of the year, you may be able to file as head of household rather than as married if you meet certain conditions. I won't take the time to go through those conditions. This video is really not about filing status. But if you want more information about filing status, if you're not feeling confident that you know your filing status and therefore can look up the right number in the table we've been looking at, you can go to IRS Publication 501, which is the publication that talks about filing status. But also, again, this wonderful tool the IRS has, the Earned Income Credit Assistant that's on their website. It will actually ask you questions to help you determine your filing status. So that's a really good place to go as well if you want help in figuring out what your filing status is. Finally, we are able to have you pick out the number from this table that applies to you. At this point, you should know how many qualifying children you have. You should have an idea of your earned income. I've defined that for you. You should have an idea of your adjusted gross income. I've defined that for you. You should have an idea of your filing status. So now you can pick out that one number of the 8 numbers in this table. You can pick out the one number that applies to you. And your income needs to be less than the number in this table in order for you to qualify for the earned income credit. And you have to look at both your earned income and your adjusted gross income. So both numbers have to be under this amount for you to qualify. So I hope now that you know whether you meet the requirement that your income must be less than a certain amount of money. So we can check that one off the list. We've already talked about you cannot file your return as married filing separately. So now we're ready to talk about the requirement that your investment income cannot exceed $3,650. I note that's the 2020 amount. All the numbers associated with the earned income credit are indexed for inflation and they change every year. So next year, that $3,650 is going to be a different number because it will be adjusted for inflation. So let's talk about that requirement. This is not a difficult requirement to talk about. Thank goodness we need a little break since we just went through a terribly complicated requirement. If you have investment income, it cannot exceed $3,650. What's investment income? It includes things like interest, dividends, capital gains, royalties, and rental income. So basically, the rules are written to say, you know what, even if your income is below a certain amount, if you have a bunch of investment income, we don't want you to be able to take the earned income credit. So there is a limit placed on that. Most people, the calculation of investment income is pretty easy. You have some interest, you have some dividends, so not very complicated. But actually, in Publication 596, the earned income publication the IRS puts out, they do have a worksheet to help you calculate your investment income. I think most people don't really need that worksheet because their situation's not very complicated, but just be aware that that worksheet is available and you may want to take a look at that. Now we can check off, wasn't that easy? I wish all these were so easy. They're not, I just wish they were. But we can check off your investment income cannot exceed $3,650. So now let's have a little sip of coffee or whatever your beverage of choice is. And let's continue down the road of the requirements. There are just a few more requirements. Whew, what a relief. And they're not as complicated as some of the requirements we've been through already. So there are 3 requirements now that we need to talk about that apply only to individuals who have no qualifying children. And if you have qualifying children, do me a favor, when I talk about those 3 requirements, tune me out because I don't want you to get confused. I don't want you to think those requirements apply to you. They only apply to people who have no qualifying children. And then there are 3 more requirements that apply to everyone. So let's tackle this one. If you don't have any qualifying children, 3 things. You must live in the U.S. for more than half the year. I did talk about that already, but it is an explicit requirement, so I wanted to mention it again. You have to be at least 25, but under 65, and you can't be counted as a dependent by someone else. I'm going to take each of those 3 rules and talk about a few details related to them. The first requirement is that you, and if you're married filing jointly, your spouse must live in the U.S. for more than half the year. We covered living in the U.S. earlier. Just as a reminder, U.S. means the 50 states and the District of Columbia. It's not Puerto Rico. It's not U.S. possession. So if you live there, you can't count that as living in the U.S. You can't count that towards this requirement. And as I discussed earlier, there is a special exception to the rule for military personnel stationed outside the U.S. on extended active duty. They do not have to live in the U.S. They will still meet this requirement. The second requirement, again, that applies only to individuals with no qualifying children, is you have to be at least 25, but under the age of 65 as of the end of the year for which you're claiming the credit. So for the 2020 earned income credit, you have to be within those ages on December 31, 2020. Here's a really important rule. If you're married filing jointly, only one of you needs to meet the age requirement. It's not required that you both meet it, only one of you. So that will help you perhaps meet the requirement. I do want to give you a little caution here, and I can't believe I'm having to say this, but I do. If you or your spouse are near ages 25 or 65 and you have a birthday within a few days of December 31, you're going to need to go to Publication 596 because there are some important details about determining your age. This really should be easy. It should be simple. What's your age on December 31? But they've created rules that aren't quite that simple, so I need to tell you about that, and you may need to go look at Publication 596, but only if you have a birthday right at the end of the year and you're close to 25 or 65. Okay, the third requirement that applies only to individuals who do not have any qualifying children, and this is the third and final special rule for those folks who don't have any qualifying children, is you can't be the dependent of another person. And if you're married filing jointly, neither you nor your spouse can be the dependent of another person. So what is a dependent? I didn't want to just throw that rule at you and say nothing about who is a dependent. I don't have time, though, to go into all the rules about who is a dependent. I'm just going to tell you that it's based on factors such as being related to them, living with them, and receiving financial support from them. If you want to be sure you know what is a dependent, go take a look at IRS Publication 501, and it will explain all that to you. But here's the thing. if you're not sure whether someone is claiming you as a dependent, just go ask them. Because if they're claiming you as a dependent, they have to identify you on their income tax return. You can just go say, hey, are you putting me down on your tax return? Are you putting my name there as a dependent? And they'll say yes or no. I have to tell you though, special rule here, special rule within a special rule. If you meet the definition to be their dependent, you can't take the earned income credit even if they're not claiming you as a dependent on their return. So in other words, if they could be claiming you as a dependent, they're just not, you don't meet the requirement to be eligible for the earned income credit. All right, we can check that off the list. We've gone through the 3 special rules that apply only to people who have no qualifying children. We're now ready for the 3 additional requirements that apply to everyone. I've boxed those in here just to help us celebrate a little that we're down to just 3 more requirements. We are getting there. It's taken a while. You can't really rush this stuff, but here we go. Let's start with you must be a U.S. citizen or resident alien all year. Well, first of all, you know, when I know when I say the term alien, some people probably think like an alien from outer space. No, that's not a concept in the income tax law. Alien just means someone who is not a U.S. citizen. I don't love the term, by the way, but it's what it is. So it just means someone who's not a U.S. citizen. And a resident alien is actually taxed in the same way as a U.S. citizen. So for income tax purposes, including their earned income credit, they're treated just like a U.S. citizen. Now, I'm not going to go into what makes you a resident alien. I explained to you that an alien is someone who's not a U.S. citizen. But to explain what resident alien means would take a long time. We're not going to do that. But you'll see the details on that in IRS Publication 519, which is called the U.S. Tax Guide for Aliens. So if you are not sure whether you're a resident alien, then go look at that. Because again, you do have to be a U.S. citizen or resident alien all year long in order to claim the earned income credit. Now, if you're married filing a joint return, both you and your spouse must meet this requirement. That's the rule. The thing about income tax rules is there are often exceptions to the rule. So here's an exception. If only one of you meets the requirement, so one of you is a U.S. citizen or resident alien, but the other is not, you can actually elect to treat the non-resident, non-U.S. citizen as a U.S. resident and file a joint return. And then you would meet this requirement. But just be aware that if you make that election, it means you're both taxed on your worldwide income. The U.S. will tax both of you on your worldwide income. So you have to do some figuring to determine whether you'd want to make this election in order to get the earned income credit. It may not be worth it because then both of you are going to be taxed on your worldwide income. I do, just so that people are not confused, I do want to report out this or explain to you this requirement does not mean that you have to live in the United States all year long. Remember, you just have to live in the United States more than half the year. The thing that you have to do all year is be a U.S. citizen all year or be a resident alien all year. So just so there's no confusion about that. So we can check that one off the list. We are getting there. The next requirement is that you must have a Social Security number, and if you are married filing jointly, then both you and your spouse must have a Social Security number. I know this seems like it should be really simple. There are some details, though, that I really do need to explain to you on that. And with that, I need another drink of water so I don't lose my voice. Feel free to join me. Okay, we're ready to dive into this one. I want to point out also, and I did mention this earlier, that in order for a relative to be counted as your qualifying child, they must also have a Social Security number. And so all the rules I'm going to talk about now related to Social Security numbers applies to that requirement as well. Don't get confused though. If a child doesn't have a Social Security number, then you cannot count them as a qualifying child for the earned income credit. But that doesn't mean you're not eligible for the credit. It just means that when you look up how much money you can make and still claim the credit, you can't count them as a qualifying child. So it would take you to a different place in that table that we looked at. And also later on, when we calculate or we determine the amount of your earned income credit later in this video, you wouldn't be able to count them as a qualifying child. So again, doesn't mean that you're not eligible. It just has to do with whether you can count them as a qualifying child. So I hope that makes sense to you. I know that can be a little bit confusing. I also just want to note, remember that resident aliens are treated the same as U.S. citizens for tax purposes, and they can take the earned income credit. If you're wondering, can a resident alien get a Social Security number and meet the Social Security number requirement? Yes, you do not have to be a U.S. citizen to get a Social Security number. So just to clarify that. There's a deadline for having Social Security numbers. So we say you have to have a Social Security number. A question is, by when do you have to have a Social Security number? Well, to claim the credit, you, and if you're married filing jointly, your spouse, have to have a Social Security number by the due date of the income tax return for the year you're claiming the credit. So for the earned income credit for 2020, you just need to have a Social Security number by the due date of your return for 2020. And in a similar way, to count a child as a qualifying child, he or she needs to have a Social Security number by that same date, by the due date of the tax return for the year that you're claiming them as a qualifying child for the earned income credit. So what are the due dates? Well, most people know that tax returns are due on April 15th. So that's usually your deadline for making sure you have a Social Security number. So for 2020, for the earned income credit, need to have the Social Security numbers by April 15th, 2021. There is an extended deadline. So if you run into an issue with you're running out of time to get Social Security numbers, you have until October 15th if you extend the due date of your return. And you can do that simply by filing Form 4868. That's called the application for an automatic extension. All you have to do is file it. You don't have to meet any requirements. If you file it, the extension is automatic. You do have to file it by April 15th. You can't let April 15th come and go and then file it later. That doesn't work. You can also get an extension without even having to file the Form 4868 if you make an electronic payment for your taxes to the IRS by April 15th. One rule is that even though you extend the deadline for filing your return, it doesn't extend the deadline for owing money to the IRS. That money's due on April 15th, so if you owe them money, hopefully you don't, especially if you get the earned income credit, hopefully you don't end up owing them any money. But if you do, if you give them an electronic payment by April 15th, then that also extends your deadline to October 15th. Absolutely no requirements to qualify for the extension. It's automatic as long as you either file the form or make an electronic payment. So what's a benefit of extending your return related to the Social Security number? Well, normally, as I said, your Social Security deadline would be for 2020, for the earned income credit, would be April 15th, 2021. But if you get an extension, that gives you an additional 6 months to get your Social Security number. I want to give you an example of where that could really come in handy. Let's say you have a newborn baby born on December 30th, 2020. And to count the baby as a qualifying child for 2020, your deadline to obtain a Social Security number for the baby is April 15th, 2021. And maybe you're busy, you have a newborn baby in the house, you're busy, you're overwhelmed, you don't even think about getting a Social Security number. Well, what you can do is file for an extension, and then that's going to give you until October 15th, 2021 to get that Social Security number. So it does give you an additional 6 months, and that could come in really handy. It would be a shame if you're not able to count that baby as a qualifying child because you just never got around to getting a Social Security number. I just want to take a quick aside here and tell you how you get a Social Security number, just in case we have folks listening to this video who need to know how to do that. What you do is you file Form SS5, which is an application for a Social Security card, with the Social Security Administration. At the time I made this video, the Social Security Administration was saying that it takes about 2 weeks to get a Social Security number once you file the application. So it doesn't take very long. What may take you a while, though, is gathering together the documentation that you have to send with the application. So don't wait too long, but at least once you get it to the Social Security Administration, it doesn't take very long. If you want more information on getting a Social Security number, you can go to ssa.gov, or here's a phone number that you can call, 800-772-1213. That's the phone number for the Social Security Administration. A couple cautions here. The rule is that you need a Social Security number. Unfortunately, not all Social Security numbers actually meet the requirement for the Earned Income Credit, either for you or for the qualifying child. The following type of Social Security card or number may or may not meet the requirement, and that would be a Social Security number that's on a Social Security card that says not valid for employment. And here's an example of what that card would look like. It says void. That's just because I took this from an IRS publication, and they don't want anyone to think that this is an actual Social Security card, so they write the word void on that. So obviously, yours wouldn't say void. But if it has those words, not valid for employment, and you got that number only to get a federally funded benefit such as Medicaid, that Social Security number does not meet the requirements for the Earned Income Credit. You may wonder, why would such a card be issued? Well, it's a card issued to people from other countries who are lawfully admitted to the United States, but without work authorization from the Department of Homeland Security. And they have a valid non-work reason for needing the Social Security number, one of which is they need it to get a particular benefit or service such as Medicaid. So that's not going to meet the requirement. There is another type of Social Security number that may or may not meet the requirement, and that is if the Social Security number is on a Social Security card that says valid for work only with DHS authorization. And here's an example of what that card would look like. DHS is Department of Homeland Security. So in order to meet the requirement to have a Social Security number, the work authorization has to still be valid. So that's the key for that to be a valid Social Security number. Why would such a card be issued? These cards are issued to people who are admitted to the United States on a temporary basis, and they do have authorization to work from the Department of Homeland Security. Now, another caution is that, the government issues various types of identification numbers. Those numbers are not going to meet the requirement that you have a Social Security number because they're not Social Security numbers. So some people have what's called an individual taxpayer identification number. That does not meet the requirement. That is not a Social Security number. Other people get what's called an adoption taxpayer identification number. That's in connection with adopting a child. That is not a Social Security number. That is not going to meet this requirement. So just want to make you aware of that. Wow, we have covered that. We are on the home stretch, at least as it pertains to the requirements to qualify for the Earned Income Credit. So we've covered the Social Security one. We're down to one last one, which is you cannot file Form 2555. So what is that? 2555, Form 2555 is called Foreign Earned Income. The reason you would file that, and if you file it, then you're ineligible for the Earned Income Credit, you would file that to exclude income earned in foreign countries from your income for U.S. tax purposes, or to exclude or deduct a foreign housing amount. Now, if you don't have any income from a foreign country, you obviously don't have to worry about this requirement. U.S. possessions like Puerto Rico, U.S. Virgin Islands, Guam, etc., they aren't foreign countries for this purpose. And if you do want more information about this, which you might if you think this might apply to you and you think you might be filing a Form 2555, go to the instructions for Form 2555. You can use that website I gave you at the very beginning of this that I've posted in the description section. You'll be able to go to that and find Form 2555. And also Publication 54, which is the IRS's tax guide for U.S. citizens and resident aliens abroad, will give you more information about that. This requirement probably is meaningless to most people, but it is a requirement, so I did want to cover it. Most people easily meet this requirement because they don't file Form 2555. Whew. We have made it. We are through the list of requirements. Hallelujah, hallelujah. That deserves another, well, I think, coffee. Congratulations. If you're still with me, thank you, thank you. I appreciate it so much. We're through all the requirements. It's been sort of a long journey down the track, but we have made it. So, just so we can pat ourselves on the back, here's the full list again. Everyone is now checked off. So how are you doing? I'm assuming if you're still listening to me that you think you meet all the requirements. I've gone through a lot of detail, so if you think you meet the requirements, I would say you probably have. So that is excellent. Congratulations. While we're reviewing, I just want to review the qualifying child requirements. I talked about that a long time ago. That's going to be important for the rest of this video as we talk about the amount of your earned income credit. It's a major factor in determining the amount of your earned income credit. I don't want you to forget what those rules are, and I want to make sure you've counted up your qualifying children. So just real quickly, they have to be related to you, your child, your brother, sister, their children, etc. They have to be under 19, or if they're a full-time student, under 24. They also have to be younger than you, or younger than you if you're married filing jointly. They don't have to be younger than both of you. Remember that the age requirements don't apply to individuals who are totally and permanently disabled. They have to live with you for more than half the year in the United States, and they must have a Social Security number. So just wanted to quickly review those rules while we were sort of in a review mode. So if you've met all the requirements, it's time to celebrate, pop the champagne, whatever you'd like to do to celebrate. Congratulations. That is wonderful, wonderful. If you want to confirm that you're eligible, so you've listened to me, and I've given you, I hope, what you think is a really good presentation on the requirements. But if you just want to confirm that you're eligible, there are a couple ways you can do that. You can use the step-by-step questionnaire in the instructions for Form 1040. There's actually a step-by-step questionnaire that will help you determine whether you qualify for the earned income credit. The Form 1040 is the U.S. individual income tax return, so you can go look at that. Or you can use, I've mentioned this tool before, it's a wonderful tool. The online step-by-step Earned Income Tax Credit Assistant will walk you through all the requirements, ask you a series of questions to help you determine whether you qualify for the credit. So just a couple ways if you really want to confirm your eligibility for the credit. Again, congratulations if you've hung in with me so far and it looks like you meet the requirements. So now, at long last, we're ready to talk about the amount of your earned income credit. This is the most fun part of this entire video because this is going to tell you how much the earned income credit is worth to you. So I know you're probably more interested in this section than any other section, and I totally understand that. So how much is your earned income credit? It's based on three factors. One, the number of qualifying children you have for the year. Two, your income tax filing status for the year. And three, your income for the year. And if you're married filing jointly, you need to combine the income. In other words, it's the income that's going to be shown on your tax return for married filing jointly. So the answer as to what your earned income credit amount is not really an easy answer because it is based on these three factors. And the formula to calculate the credit is unbelievably complex. I'm actually going to sort of explain the formula to you, but you know what? It is so complicated. I will tell you that in studying the earned income credit, that is the thing that I had to spend the most time on in really learning the earned income credit is the formula that calculates it. But fortunately, Congress, when they enacted the earned income credit, even though they chose to have a very complicated formula, they realized it was so complicated, they said, we don't want anyone to have to actually use the formula. So in the law itself, they mandated that the IRS create a table which allows us to simply go in with our income amount, go into the table, and look directly at what your earned income credit amount is. So you don't actually have to worry about calculating the credit. It's simply going into a table and looking up the amount of the credit. What I'm going to do a little later is I'm going to show you some tables where you'll be able to at least get a good idea of what your credit is. Now, the IRS table, here's what it looks like. This is just a small portion. It's actually 9 pages long, and it has, I actually calculated how many earned income credit amounts are in that table. Are you ready? 9,096 earned income credit numbers in that table. It goes on for 9 pages, and it's number after number after number. In an ideal world, I would show you, I would scroll through those pages with you very slowly, give everyone a chance to look up their earned income credit amount, and then you would know. But it would take a long time to go through 9 pages slowly enough that everyone can find their number. So that was not a good alternative for me. I knew that. So what I'll do later, I'm not quite ready to do it because I want to explain some things to you first, but what I'll do later is I'll show you tables that have various levels of income, and you'll be able to look at the number that's closest to your income level and then look up in the table that I show you your earned income credit amount. It won't, unless the number in the table is exactly your income, it won't be exactly your earned income credit amount, but it will be pretty close. And then you'll have an idea of what it is. So that's the way I'm going to approach this. And by the way, the numbers in my table that I'll be showing you later are taken directly from the IRS table. Now, I know at some point you're going to want to see the actual number in the IRS table. So I want to tell you where later on, I hope you don't stop the video now and go look. Don't do that because I think I need to explain some very important things to you first. But where can you actually find the IRS table? 2 places. First, it's in IRS Publication 596, their publication, their major publication on the earned income credit. And just so you don't have to spend a long time looking for it in that publication, it's near the very back of the publication. You can also find it in the Form 1040 instructions, the instructions for the individual income tax return. And there, it's not in the back, it's in the section that discusses the earned income credit. If you go to the index, it'll tell you where the discussion is of the earned income credit, and you'll find it in that section. So 2 places you can find it. There's some good news here. You know, if you don't even want to go to the trouble of looking up your earned income credit amount in the table, maybe it makes you nervous because you're thinking, I'm not sure I'm looking up in the table in exactly the right way. You don't actually have to look it up. If you prefer, the IRS will determine the credit amount for you, and here's how you tell them that you want them to do that. There's a line on your tax return, it's line 27, that says earned income credit. So to tell the IRS that you want them to look up your credit for you, just leave that box blank. So where you're supposed to write in the amount of your earned income credit, leave that blank. And then they have you, what they want you to do is write the initials EIC on the dotted line next to the blank box. They then don't want you to put amounts at any of the boxes on your return that show things like your total tax payments, overpayment, refund, amounts you owe, because those amounts all depend on the amount of your earned income credit. So they don't want you filling in those boxes either. They want you to leave all those blank. So if you want the IRS to look up the number for you, because maybe you're a little nervous about doing it yourself, this is what it's going to look like. There's line 27 on your tax return. It says earned income credit. And just on that dotted line, write EIC, and then don't put any amount on line 27. That's how you do it. This is important. If you decide to do it that way, please know you should not ask the IRS to determine the credit amount for you unless you've already determined that you're eligible for the credit. They do not want you writing EIC on the dotted line so that they can figure out whether you're eligible. They're not going to do that. When you put EIC on that line, you're telling them that you are eligible and you simply want them to determine the amount of your credit. They will not be amused if you write EIC on that line and you aren't eligible. So please, don't do that. It can get you into trouble with the IRS. Very important point. There's some other alternatives to using the IRS table yourself. Again, I don't want to scare you away from using the IRS table. It's not that bad, but if it does make you nervous, some other ways that you can avoid having to use that table yourself, you can use tax preparation software that'll determine the accredited amount for you. You can actually use the IRS's Earned Income Credit Assistant that I've talked about earlier. That online tool, if you put in your income amounts, and assuming you get those income amounts input correctly, that assistant will go into the table for you and look up the amount. So that's one way to do it. Obviously, you can have someone else prepare your return for you, and then they're going to look up the amount for you. But no matter which of those alternatives you use, they're going to go look at the IRS table to determine the credit amount, because that's how it's done. Everybody has to use the earned income credit table put together by the IRS. Now, while we're talking about using software, having someone else prepare your return, I just want to do a quick aside and make you aware that you may be able to use free software available through the IRS to prepare your return. It's called the IRS Free File Program. It's available to taxpayers with adjusted gross income of $72,000 or less. So basically anyone who qualifies for the Earned Income Credit should be able to use this program. If you want details, I've shown you the web address here where you can go get details, and completely free of charge, you can use this program to do your tax return using an online tool. So very, very helpful. Also wanted to make you aware, maybe you don't feel comfortable really doing your return at all. You want someone to help you with it. You may be able to have someone prepare your return for you at absolutely no cost to you. And one option, some organizations will do that for you. You can search those out. But one option that's available through the IRS is what they call their Volunteer Income Tax Assistance Service. And in that service, returns are actually prepared by volunteers who are certified by the IRS. And that program is available to people who generally make less than $57,000 a year, individuals with disabilities, and people with limited English speaking skills. So that's available. I wanted to make you aware of that. If you want details on that, including locations where you can go to have people prepare your return for you, just go to irs.gov/VITA. So hopefully that's helpful if you want some help. Now, probably the moment that we've all been waiting for, and I love talking with you about this, you're asking, Eddie, can you give me a general idea of how much my credit might be? Yes, in fact, I'm going to give you more than a general idea. I'm going to give you a good approximation of what your credit will be. I want to first, though, I'm going to show you some tables in just a little bit, but first I really want to help you understand how basically it's calculated. How's the IRS put that table together? If you don't really care about that, you may want to skip straight ahead to where I talk about the tables. I'll certainly understand, don't worry about offending me, but I just thought there might be enough people who really want to have a general idea of how the credit's calculated, so it's not sort of a black box, like it's just a big mystery. So I'm going to explain that to you now before we start looking at specific numbers. So it's a very complex formula, as I mentioned before. But when you break it down, what you realize is that the complex formula really results in 4 groups of people. So I'm going to go through each group, and you'll see which group you fit into and get an idea of your credit amount, because ultimately I'm going to show you tables where you can look up your credit amount broken down into the groups. So let's talk about those groups. So here they are, and the first thing that's important to note is that the groups progress from lower income to higher income. So from the left side, it's lower income people progressing over to higher income people. So I have my first group, and for this group, so people who have the lowest income, the higher their income, the higher their credit. Then I get to the second group. The second group has higher income than the first group. The second group, everyone within a certain range of income receives the same dollar amount of credit. Then I have the third group. The third group has higher income than either the first or the second group. And for this group, the higher the income, the lower the credit. That's why I put an arrow there going down. The higher income, the lower the credit. And then the fourth group, which makes more money than the first, second, or third group, they have higher income. Their income's too high to receive the credit. We've really already talked about that when we looked at that table that showed how much money you can make and still get the credit. That's why the formula is so complicated, because it has all these different groups progressing from lower income to higher income. Here I want to show you, kind of graph it out. I love this chart. That's why I'm taking the time to explain this to you. This is a chart put together by the Congressional Research Service that really depicts graphically how it's calculated. And I've actually labeled, I've added to their chart, Group 1, Group 2, Group 3, Group 4. They didn't have those labels on their chart, so I sort of modified their chart just a bit. This is an example for a single taxpayer with one child. It doesn't really matter. The graph's going to look very much like this for other situations, like a married taxpayer with 3 children. So the gist of it is the same regardless. So here's the way this little chart is laid out. So look at the bottom, it says earned income, and it has earned income all the way over on the left side, starting at 0, going across all the way over, going up to $45,000. Now, back to the left side. Notice that as we go up the page, those numbers are the earned income credit amount, starting at 0, then going to 1,000, 2,000, etc., all the way up to $6,000. Here's the way it sort of graphs out. We have the first group, which they call the phase-in group, where the higher the income, the higher the credit. Then you get to group 2, which they call the plateau group, where everyone within that range of earned income gets the same dollar amount of credit. Then we get to group 3, and they make more money than groups 1 and 2, and they call that the phase-out group, where the more money they make, the less their earned income credit, so that line then is going down. And then finally you get to group 4, and they make too much money, and they don't get any earned income credit. So as you can see from here, it's not simple. It's not like there's a line going up, just one line going up, or just one line going across, or one line going down. You have these groups, and you're treated differently within each group. So that's what makes it so complicated. So now, at least you have an understanding of generally how it's calculated, and it's not going to be a complete mystery to you. And that's why I decided to go through this. I didn't want it to be just a complete mystery to you. Before we jump into the tables where you're going to be able to look up about what your earned income credit is, there's a very special rule that I absolutely have to tell you about. I would be very remiss if I skipped this rule. This is a very important rule. So before I can explain the special rule to you, I need to tell you about what the normal rule is, because the special rule is special because it's not the normal rule, obviously. So the normal rule is that when you determine your 2020 earned income credit amount, you look at your 2020 earned income. The special rule says if and only if your 2020 earned income is less than your 2019 earned income. So let me say it again. If your 2020 earned income is less than your 2019 earned income, then you get to choose between using your 2020 earned income or your 2019 earned income to determine your 2020 earned income credit amount. In other words, when you go to the table, either the IRS table or the little tables I'm going to show you later, to calculate or to determine, you don't calculate, you just look it up, to determine your credit, you can use either your 2019 earned income or your 2020 earned income. You have the choice. Why do we have this special rule for 2020? It is a special rule for 2020. It didn't apply in the past. Well, actually, there have been times that there have been special rules enacted in the past, but usually we have years that don't have any special rules like this at all. Congress actually decided to create this special rule because the coronavirus situation has caused many people to have lower incomes in 2020 than they had in 2019. People got laid off from their jobs. they didn't make as much money in 2020 as in 2019. And Congress didn't want those lower income amounts in 2020 to result in people getting a lower earned income credit in 2020 than they got in 2019. So by letting people choose to use 2019 earned income to determine the 2020 earned income credit, it may, for those individuals, keep their earned income credit amount up at the level it was for 2019. So it's a really nice rule. It is a completely voluntary election. It's not automatic. You choose whether you want to do that. So it's important to know that it's voluntary. Why would you choose it? Well, you would make the choice to use your 2019 earned income to calculate your 2020 earned income credit if using your 2019 earned income rather than your 2020 earned income results in a higher income tax credit for 2020. Makes total sense. Now, whether it results in a higher credit depends on your income level. It really depends on which of those groups that I talked about earlier, which of those groups you're in. I'm going to go through some examples with you on that a little later. I am going to hold off and not do those examples right now because I think the examples are going to make more sense to you a little bit later. So that's the reason I'm holding off. Now, it is a good idea. In fact, it is a no-brainer idea. It's obvious that you need to do this. Determine the credit amount using both your 2019 and your 2020 earned income and just see which one results in a higher credit. It's simple as that. Now, if you make the choice to use your 2019 earned income, the IRS does want you to indicate on your income tax return that you made that choice. What they want you to do is on the dotted line for line 27, which is where you enter the amount of your earned income credit, they want you to write the initials PYEI, which stands for prior year earned income, and the amount of your 2019 earned income so that they know that you have made this election. Here's what that would look like. So there's line 27, earned income credit, and you're going to write PYEI and then the amount of your 2019 earned income. In my little example here, I've written $14,500. That signals the IRS you've made the election. Make sure if you do make that election that you follow this instruction from the IRS. I'm concerned if you don't, they may try to sort of recalculate or determine how you came up with your earned income credit, and your number won't make any sense to them, and because they won't know that you made the election to use your 2019 earned income, and then you may hear from them, and no one likes to hear from the IRS, right? So avoid that by making sure you make this designation on your tax return. Now, we are getting ready to jump in to the tables, go through the groups, and enable you to look up the amount of, or approximate amount anyway, of your earned income tax credit. I'll explain in a minute why I keep saying approximate. Keep in mind that dollar amounts on these tables are for the year 2020, tax returns due in 2021. I'm just saying that in case a couple years from now someone's watching this video and they don't realize that the numbers change from year to year, but they do. All the numbers get changed from year to year based on inflation. So these are the 2020 numbers. So the first group, remember I said the first group, the higher their income, the higher their credit. Well, the way this group works, the way the formula works, is that the credit for this group is a percentage of earned income. And the percentages for this group are actually the same regardless of filing status, so it doesn't matter whether you're married or single. And the way you determine your credit in this group is it's just a percentage of your income. And it does depend on the number of qualifying children. So look down the table and think about your earned income. So for example, if you have 2 qualifying children and your earned income is between $1 and $14,849, your earned income credit is 40% of your earned income. That's how it's calculated. Now, you won't actually do that calculation because you're going to go to the IRS table and look up the amount of your earned income credit. But I wanted you to know how it's calculated. So that's how it's calculated for this group. If you try to do the math and compare it to the IRS table, just be aware that your number's probably not going to match exactly what's in the IRS table because the table has income in $50 ranges. If they didn't, the table would be hundreds and hundreds of pages long. So they use $50 ranges, and so they do some rounding. So you may not come up, if you try to recalculate on your own, you're probably not going to come up with exactly the amount in the IRS table. So that's group one. So here is a table, if you fall in group one, that will tell you what your earned income credit amount is. Now, of course, I don't have every earned income amount in here, but I think I have enough listed that you can find a number that's close to your earned income and be able to then look across the table and based on your number of qualifying children, see what your earned income credit amount would be. If you make more money than this, don't worry, we're coming to tables later that will apply to you. Let me do an example. Let's make it easy because I'll go to the bottom row here. Let's say your earned income is $14,500 and you have 3 or more qualifying children. Your earned income credit amount for 2020 is $6,536. Now note, let's say your earned income is $7,500 and you have no qualifying children. You're not in the first group, you're going to be over in the second group. So take a look. If these numbers are applicable to you, just make a note of about what your earned income credit amount will be. Now we're ready to go to the second group. So remember I said the credit for this group is a specific dollar amount. And by the way, this group receives the highest credit dollar amount of any group. So the way this works, now it does depend on your filing status, whether you're single, head of household, qualifying widower, or married filing jointly. So you look in the table, you say, how many qualifying children do I have? And does my income, my earned income, fall within these ranges? If it does, and based on your filing status, if it does, go over to the last column. That is precisely the amount of your earned income credit. Because this group, they all get the same dollar amount, and so it's just easy to show what that dollar amount is. So let me do an example. Let's say you have one qualifying child, so we're on that row, and let's say that you're single and your earned income for 2020 falls between $10,500 and $19,349. Go all the way across to the final column. Your earned income credit amount is $3,584. So take a look. If your income is falling within these ranges, then this table tells you exactly what your earned income credit is. Hopefully that all makes sense. So that's the second group, that plateau group, where everyone within these ranges gets exactly the same amount of earned income credit. With that, we're ready to move on now to the third group. The third group is really complicated. I'm going to apologize in advance that it's so complicated. This group receives a smaller credit than the previous group. This is the group where the higher the income in this group, the lower the credit. Here's the thing. For this group, when we say income, it means the greater of earned income or adjusted gross income. The previous two groups just looked at earned income. They didn't have to worry about adjusted gross income. This group has to look at the greater of earned income or adjusted gross income. Now the way this works is, again, you look at the number of qualifying children, you look at your filing status. Look how complicated this is. Let's do an example. Let's say that you have no qualifying children and you're married filing jointly. What this says is that for every $1, look at the wording at the top of the table, for every $1 that income exceeds this amount, so in the case of no qualifying children and married filing jointly, $14,699. So for every $1 that income exceeds $14,699, the earned income credit is reduced by 7.65 cents. Thank goodness we don't actually have to do these calculations. Thank goodness the IRS has the table. This particular group, the calculation is sort of ridiculously complicated. I don't know, how does Congress come up with this stuff? I don't know. It is so complicated. but I don't think you're even going to try to do this math. Don't bother. Let's just go to the table. Now here, because there's so many numbers, I have divided the table between single head of household, qualifying widow, widower, and married filing jointly. So first, we're going to do the single head of household, qualifying widow or widower. So you'll see down the side various income amounts. Remember, use the greater of your earned income or adjusted gross income to look up your credit in this table, and it's going to show you your credit. And you'll see that it's only showing the third group. So some of these income levels are in the fourth group, some have already been in the first or second group, because it's also complicated and it depends on your filing status, etc. So for example, if the greater of your earned income or adjusted gross income is, let's say, $30,000, you're single, you have 3 or more qualifying children, then your earned income credit is $4,408. That's how this table works. So see if any of these numbers apply to you, and it should give you an approximate idea of your earned income credit amount. Just pick a number that's the closest to your earned income or your adjusted gross income, whichever is greater. Now the third group, if you're married filing jointly. So the same kind of table, this is just the table for people married filing jointly. So again, your income is the greater of your earned income or your adjusted gross income, and then it's also dependent on the number of qualifying children. So take, for example, the income figure is $55,000, and you're married. This is the chart for married, and you have 3 or more qualifying children. Your earned income credit amount is only $383. Obviously, it's been phased way down because of your income level. We have the fourth group. The income for this group is just too high to receive the credit. This is actually the table you've already seen. If you make this much money or more using earned income and adjusted gross income, so really the greater of the two, then if you make that amount of money or more, you make too much money, your earned income credit amount is 0. So now I hope you have a good idea, an approximate idea of the amount of your earned income tax credit. To get a better idea, really a precise idea, go to the IRS table and look it up, because they have all the income levels in that table, whereas I've only shown the amounts in like $5,000, $10,000 increments. Now I am ready to take you back to that special rule that allows you to use your 2019 earned income to determine your 2020 earned income credit amount. I saved this because I thought you would better understand these examples once I'd gone through all the 4 groups and showed you numbers. Before I go through this example, I need a drink of water, so give me just a moment. Excellent. Okay, so this example is for married filing jointly with 2 qualifying children. I had to pick a scenario in order to just have an example and use real numbers. But you'll get the gist of it, even though maybe you're not married filing jointly with 2 qualifying children. And I have 3 examples here. I'm going to walk you through each example one by one. In the first example, the earned income for 2019 was $14,500. When I take the 2019 earned income and I go to the table, and with that figure, the $14,500, when I look up the earned income credit amount for 2020, it's $5,810. Now, in this example, the 2020 earned income goes down to $10,000. So the earned income dropped from 2019 to 2020. When I take the 2020 earned income and go look it up in the IRS table, it shows me an earned income tax credit of $4,010. Well, I'm definitely going to make the election to use 2019 earned income, because that's going to get me a credit of $5,810 versus $4,010. So definitely want to make that election. By the way, this scenario, they're in that first group where the higher the income, the higher the credit. So it makes sense for them to use the higher amount of income, which is their 2019 earned income, to determine the credit. Now let's go to example 2. In example 2, the 2019 earned income is $25,000. When I go to the table and look up the credit for $25,000 of earned income, it tells me that the earned income credit for 2020 is $5,920. Now let's say that the 2020 earned income goes down to $15,000. So it's dropped from $25,000 in 2019 to $15,000 in 2020, likely because of the coronavirus, although it could be for other circumstances, and it doesn't really matter what the circumstances are. It doesn't have to be due to the coronavirus. When I look up $15,000 earned income in the table, it shows me a credit amount of $5,920. So either way, the credit's $5,920. It doesn't really matter whether I make the election, so I won't actually make the election. The reason example 2 turns out this way is the fact that this person is in that second group, the plateau group, where they're in that range of income where everyone within that range gets the same amount of credit. So the election didn't really matter. Now let's go to example 3. In example 3, the 2019 earned income is $45,000. When I go to the IRS table for 2020 and I look up the earned income tax credit for $45,000 of earned income, the credit's $1,749. In 2020, the earned income went down to $30,000. It dropped from $45,000 to $30,000. When I go into the table and look up $30,000 of earned income, it shows me that the credit amount corresponding to that income level is $4,908. In this example, I do not want to make the election because by making the election, my credit would be $1,749. I'm better off to use 2020 earned income and get a credit of $4,908. So I do not want to make that election. The reason example 3 turns out this way is in example 3, we're in that third group where the more money you make, the lower the credit. So you're better off to use the lower earned income amount for 2020. So hopefully those examples make some sense to you. Again, make sure you look up in the table using both your 2019 earned income and your 2020 earned income, and then make the decision based on which one gives you the higher earned income credit amount. Wow, we have finished the amount of your credit. So at this point, let's just sort of sit back, pat ourselves on the back. Hopefully you understand how credits work. We've been through the requirements to claim the credit, and I'm assuming if you're still listening, you meet the requirements, and now you have a good idea of the amount of your credit. We can't stop here because now we have to know how to claim the earned income credit. It does not do us any good to be eligible and know the amount unless we actually claim the credit. So how do you go about actually claiming the credit? The next several slides I'm going to go through with you assume that you prepare your own tax return. Now, if you use software, the software is going to lead you through the process. And if you have someone else prepare your return, they're going to go through the process, but they're going to need to ask you probably a lot of questions related to the earned income tax credit. So you may not prepare your own return, but this is still going to give you a feel for what should be done regardless of how your return is prepared. Now, to claim the credit, and I said this earlier, much earlier, I want to say it again, you have to file an income tax return. You don't get the credit automatically. There are 2 types of returns on which you can claim it. You can use Form 1040, which is the sort of regular U.S. individual income tax return, or you can use Form 1040 SR, which is the U.S. tax return for seniors that can be used for taxpayers age 65 and older. As I mentioned earlier, on your return, you can figure the amount of the credit, or you can have the IRS figure the amount of the credit. I've gone through with you how you go about getting the IRS to figure the amount of the credit for you. Assuming you're going to figure it yourself, and of course you're going to use the table as I've mentioned, but what the IRS has you do is they want you to use the worksheets in the instructions for Form 1040. Those are also the instructions for Form 1040 SR. So they have a worksheet that takes you through writing down your earned income amount, your adjusted gross income, figuring whether you have to use adjusted gross income or you can just use earned income. They go through all that with you. So you fill out those worksheets. You do not file those worksheets when you file your return. But please, please, please be sure to keep those worksheets for your records, because if the IRS were to ever audit you, and I hope they never audit you, but if they were, then you would really need to have those worksheets to be able to show them. And then once you've filled out the worksheet's going to take you to the IRS table. You're going to you're going to look up the amount of your credit in the table, and then you're going to enter the amount on line 27 of Form 1040 or 1040 SR. It's the same line on both. And here's what that looks like. You've seen this before in some of my prior examples. Line 27, earned income credit, write in the amount on line 27. That's how you claim the credit. Simple as that. By the time you get to that, it's really simple. Up to this point, hasn't been so simple. I'm sure you agree with that. You may be required to complete and attach a Schedule EIC to your return. This applies if you have any qualifying children. The Schedule EIC is actually called Earned Income Credit Qualifying Child Information. And the purpose of Schedule EIC, which you do file with your return, is to give information to the IRS regarding each qualifying child. On that form, on that schedule, you put in the name of the individual, their Social Security number. Remember, they have to have a Social Security number to be a qualifying child, their year of birth, how they're related to you, and the number of months they live with you. This helps the IRS figure out if they meet the requirements to be your qualifying child. You'll note that I've said here on this slide, make sure the name is the same as it is on the Social Security card, and make sure the Social Security number is correct. You also need to make sure the year of birth, relationship, and number of months live with you is correct. But I'm highlighting those two things simply because the IRS says that one of the main issues they encounter with the earned income credit is people don't put a name on Schedule EIC that matches the Social Security card, or they don't get the Social Security number right. The IRS is going to look this up when you put this on Schedule EIC, and so you want to make sure it's going to match up with Social Security records. So that's very, very important. Here's what the Schedule EIC looks like. This is not the whole form. I just want to give you a little snapshot of what it looks like, but you can see there it starts out with having you list the child's name. It only has you list up to 3 children here on this snapshot because it doesn't matter if you have more than 3 children. And you put in their name, their Social Security number. The form goes on and has you also provide the other information. And again, that has to be attached to your return. There's an additional form required if you pay someone to prepare your return. And whoever that preparer is, they should know this and they should give that form to you and file it, or if they're filing, probably electronic filing, they'll file it for you. But it's Form 8867. It's called the Paid Preparer's Due Diligence Checklist. What that form does is ask the person you pay to prepare your return certain questions related to the work they did to confirm that you're eligible for the earned income credit. And again, that form does have to be filed with your return, but it's really the responsibility of your paid preparer to do that. It's only if you paid someone to do it, your return, that this particular form is required. So that's pretty much it on how you claim the credit. We are almost at the end. Thank goodness. Thank you. If you've hung in this long with me, you deserve like a medal. Thank you so much. I did want to cover a couple other questions. One is, when do you actually get the money for the credit? Well, not until after you file your return, because remember I said that you do have to file a return to get it. And by law, if you claim the credit and the IRS owes you a refund, they can't send you the refund any earlier than the middle of February. So you won't get it any earlier than then. So for example, you're claiming the credit for the year 2020. You file your income tax return sometime in 2021, And if the credit results in the IRS owing you money, which it almost always does when you file the earned income credit, unless maybe your employer tax withholdings are short or something like that, but they usually owe you the money. They will send you the money, but again, by law, they can't send it to you any earlier than the middle of February, so don't expect to see that money until at least the middle of February. Another question that comes up, and I thought it was important to cover it, is will getting the money cause you to lose any federal benefits? Fortunately, the answer is no. The money's not going to cause, it's not going to count as income in determining whether you or anyone else for that matter are eligible for various federal programs or the amount of money you receive under the federal programs. So it doesn't count as income. And that's for programs like the Temporary Assistance for Needy Families, Medicaid, Supplemental Security Income, food stamps, or low-income housing. I do want to note that if you save the money, so you get the earned income credit and you put it in savings, it is going to count as a resource in determining your eligibility for these benefits, but it won't be counted as a resource for at least 12 months after you receive it. I want to part here with some additional good news. I think the whole earned income credit is really good news, but here's some additional really good news. If you live in a state that has income taxes, your state may also have an earned income credit, and the amount will be based on the amount of your federal earned income credit. If you want to look at a list of states that do have an earned income credit, the IRS has a website where you can go to get that information. And I will try to also put this website, because it's so long and hard to write it all down, I'll try to also put this in the description section for this video to make it easy for you to get to that website. So we have come to the end. Thank you so much. We've covered 1, how credits work, 2, requirements to claim the earned income credit, 3, the amount of your earned income credit, and then finally, how to claim the earned income credit. If you have questions, you're confused, whatever, maybe go back and listen to portions of this. And remember, I have put links in the description section that will take you to certain parts of this video very quickly, so you don't have to find it on your own. But another thing you can do is go to IRS Publication 596. It's their major publication on the earned income credit. It's very comprehensive, so it should be helpful in answering questions. Also, the IRS has a dedicated web page with all kinds of links with lots of information about the earned income credit, and that's at irs.gov EITC. So that's a good place to go look as well. I want to thank you so much for watching this video. I say if you've made it all the way through this video with me, then you deserve, let's see, take the day off, take the rest of the day off, take tomorrow off, pat yourself on the back. Thank you so much. I really do hope that you feel like it's been beneficial to listen to this video. I feel like you've learned at least a little something, maybe a whole lot. Again, thank you so much and take care.